Bienvenido todo el mundo al Retiro con Estilo. Yo me llamo Alejandro Burguía. Estoy con mi socio, el licenciado Wade Faub, y nuestro invitado, Roberto T. French. ¿Cómo estamos?
I was wondering if you're actually going to translate the last name or not here.
Hey, Roberto Francés. ¿Cómo estamos todo el mundo? ¿Cómo estamos?
Impressive. Hopefully folks are still listening in though and not thinking
Spanish. This is not impressive stuff.
Hey man, so many times I get to impress Wade, so let me just soak in. Calgon, take me away as I soak into that bath of Wade's compliments. So Wade, a burning question all of our listeners want to know, all of them being all three of them, want to know how many push-ups? How many push-ups are we up to?
I'm getting back on track again today, but I have
back on track.
I got my vaccines. I got a round of vaccines that left me unable to do push-ups for a couple of days.
It's a want. You gotta want it.
My way up.
You gotta want it, man.
I'm still on track. We're gonna get up to 100 a day soon.
All right. How many days in a row? Well, how many days in a row have you done?
And I'm doing real push-ups. I wonder if you're doing.
Oh my god! I don't know. If you're on YouTube, are these real gains? How many days have you gotten?
Well, I've not had a day with 100 yet, but I'm
no, but it just.
Towards 100.
Hey, we're just happy you're here. We're just happy you're here at the gym. That's all. We're just happy you're here.
That's right.
It's a no judgment zone, just like what is it, Planet Fitness or something like that. Yeah. All right. Well, I've kept it up, man, and I've done 100 real ones. My kids are there, and they always like bother me. Not in a row though. I do like 25 or 30. 25 or 30 is kind of where I'm at.
At a time. Yeah.
Yeah, because I'm working on the negative. I'm working on the negative.
20 in a round, and then you get up to 20 or 25, 4 or 5 times a day. You'll be there.
So people won't recognize us. Yeah. What about you, Bob? Are you doing anything or just consuming calories?
I do work out. I'm not doing 100 push-ups a day. I'm not on this train. But
what are you doing?
Just general stuff. I'm running, and what my trainer tells me to do.
You know what that means? You know what that means, Wade? Not a damn thing is what he's doing. A full day for him is, I closed my loops, or I'm halfway through my loops, or something like that. Do you have an Apple? You use an Apple?
I don't use an Apple Watch.
Me neither. I can't stand the hegemony.
I don't know what I do with it. It's, I don't know the benefit of having all that stuff on my wrist when I've got my phone in my pocket.
No, I it's too much. It's too much. And plus, when I type, I always take off my watch because it bothers my wrist. Maybe I'm not doing the keyboard correctly, and it's taking off, put it on. Yes. Who has time for that, right, Wade?
That's right. Yeah.
But do you use Apple?
Okay.
Oh,
I do. I have an iPhone.
I do not care for it.
Oh, yeah. You see, Wade and I. You see, that's why it's Wade and me, Bob, and you have to be a guest.
Yeah.
Because I don't want to send you a text and it's the wrong color.
Yeah, my kids have iPads.
Did Bob just drop like?
I did not. I did not. I almost did. But it is incredibly annoying. Your texts are green. It's just the worst thing in the world.
Believe it or not, it is a thing amongst my boys where they have Apples, and it's not just that they're green. It's like to be in like conversations, like in threads or whatever. It's something about it that
it's something that's weird. I don't know where it is, but yeah.
Yeah, it's kind of like a middle finger to everyone else. But yeah, there it is, right? Speaking about middle fingers, Wade.
Supposedly Apple is hip, and if you're cool, you use Apple, and if you use Android, you're old-fashioned. So I guess I'm old-fashioned, but I can't stand Apple products.
I'm like, actually, I think the Samsung that I have is like actually better than an Apple, but it's almost like even if it wasn't, I'd probably do a Samsung anyways, because I think I'm naturally a bit of a contrarian like that. Like, I don't want to do what everyone is doing just because, kind of thing.
I've never noticed that
where all the buttons are. How to do stuff.
Yeah.
Only one mouse.
I'm not a sheep. I'm not a sheep like Bob.
That's right.
All right.
Anyway.
So ¿De qué vamos a hablar hoy? What are we talking about today, gentlemen?
Well, we're going to wrap up our series on inflation that Bob has been a very big part of helping us out with this. We want to go through the retirement income styles. It's somewhat a way to review what we've been talking about, but specifically, how do you manage inflation with each of the 4 retirement income styles?
Okay. And before that, yes, it sounds excellent. Before that, I got a Godfather reference here. Just no. I was at a conference in parts unknown, right, in Indiana, and I was sitting at the table with these 2 ladies, and we were advisors, and we were talking for whatever, and they mentioned The Godfather as being a bad movie because it's really a guy movie at heart, and that's all it is, that kind of thing. And I was like, I disagreed, obviously. It's a work of art. Well, not the third one, right? And then I started watching White Lotus with my wife, like last week, season 2. And there's a bit where they go into The Godfather, how it's like it's a guy movie. They were kind of like, it was like repeating what I heard, and I was like, oh, that's where they got it from. So, Bob, does art imitate life, or does life imitate art?
I don't know, but I've never watched The Godfather, and because of you, I know.
It is a violent movie.
Yes. Okay. Inflation.
This is not going where you wanted it to, is it?
No, I don't care. I just wanted to throw that in there. A bit is, I figured there's some people that are like, let's get to the topic. And I'm kind of messing around a little bit. I'm breaking that 4th wall with our listeners.
Yeah, I see those 1-star reviews starting to flow in.
My cup runneth over.
Yeah.
All right. Inflation, take it away.
Yeah. So I think a good place to start with this is actually before we even get to the quadrants. It's incredibly important to recognize, we all, to a very much, a very big first assumption, we all get Social Security. That's going to cover a lot of most people's essential expenses. And that is inflation adjusted inherently. There's some small groups of people who don't get Social Security, railroad workers and, some other folks. But by and large, everyone does. That is kind of the baseline for most everyone's retirement plans. That is the baseline for how most everyone is going to deal with inflation. And that's always a good place to start these conversations. And I know we've mentioned it in, I think, every past episode where we've been talking about this, but that's for a reason. That is incredibly important here.
Yeah, it's huge. It's a big chunk of inflation adjusted lifetime income. And the other thing we should just mention up front too is not everyone's spending needs are going to increase with the overall consumer price inflation throughout their retirement. A simple assumption in the 4% rule is your spending always grows with inflation. But we do know that people voluntarily, it's not just because they run out of money, they voluntarily reduce their spending, or at least their spending doesn't grow with the overall inflation rate as they go through retirement. We have the go-go years, the slow-go years, and the no-go years. People just naturally spend less as they age, other than like David Blanchett's spending smile with how your spending declines. And then late in life, healthcare expenses may start to go up. But still, overall, you're spending less on a lifetime basis compared to if you always just increased your spending for inflation. So between that issue and Social Security, it's not as though you need to make sure that every asset you have is somehow linked to the consumer price index.
Absolutely. Yeah,
well, this was talked about yesterday too. I mean, not yesterday. Whenever we recorded last week, sometime.
It's actually weeks ago.
Yeah, 2 weeks ago. Yeah, a few weeks ago. Yeah. Boy, we need to work more. No, but it came up right where we got caught up in. Okay, does this asset class track inflation and this over engineering of making sure every single thing is, an inflation hedge, and that's not necessarily a need.
Absolutely. Mm-hmm. So, with those two massive caveats in place, that you've just got something that isn't a big something that's inflation adjusted by dint of paying into the Social Security system. And your spending is not always going to track inflation. You're not going to be jumping out of airplanes when you're 80 years old, most likely. You're going to slow down. You're not going to spend as much money. We can get into the conversation of all of that other stuff that we do want to talk about from an inflation perspective. So let's just walk around the quadrants here, I guess. So starting with total return.
And probably most listeners are familiar with the retirement income styles.
Yeah, well, that's probably a good.
If you're a new listener, if you're a new listener, welcome. So the retirement income style awareness, we talk about 4 different approaches to thinking about how people think about building their retirement strategies, and we'll go through those. And as we begin with each style, we'll just give a brief mention of what it means, not to bore the audience who already knows. But we'll start with total returns. In total returns, that retirement income style is more comfortable relying on market growth, wanting to keep optionality for their assets, and is generally comfortable using a diversified investment portfolio to source even essential spending beyond Social Security. They don't really feel a need for protected income sources like annuities or individual bonds or bond ladders. They're comfortable with a aggressive, diversified portfolio to provide the growth they need to source their spending in retirement. So that's what the total return style is. And with that being said, Bob, sorry to interrupt you with what you were saying.
No, that was a pretty important interruption, I think. But I would say total return is pretty straightforward in terms of dealing with inflation. You invest your money. You put your money in the stock and bond market, the financial markets generally. And as we talked about in previous weeks, I guess that's 2 weeks ago now, over time, the expected return of risky financial assets is higher than inflation. And if you are investing for any meaningful length of time, the chance that you will outgrow inflation is pretty darn high. It's not 100%, but that's kind of the nature of the beast when we're talking about that total return quadrant. You're banking on those expected returns basically panning out. So you're able to just build into your plan that your distributions will grow with inflation. That's just part of your plan. There's nothing special that needs to be done or anything like that.
Bob, to add to this, because this goes back to what you said previously when we were talking about gold, Bitcoin, you're bringing up assets. Bob used specifically the word outgrow, not hedge.
Mm-hmm.
And that's important because you're right. I mean, look, total return is the real concern there is, are you constructing a portfolio that is set to outgrow / hedge a little bit, whatever, inflation, if you can. You can't, you're not going to get anything. And so what we were speaking about last time, your best bet is just to get a diversified portfolio according to your risk capacity. See how I said that? Capacity. According to your risk capacity and tolerance, in which will ultimately outgrow inflation. I think, to me, that would be the goal, not necessarily think about it as hedging. I have this, and when this goes down, this will go up. That you can get into this mental sort of academic exercise. I think more important is just make sure the expected return is has a X plus 1 relative to inflation, and it's getting you there. But go back to that episode if you need to, but when you construct that portfolio, make sure you have a healthy dollop of things that will be able to do so, because I don't want to give anyone the impression, I'm in a portfolio that's 10% equities, 90% fixed income, and the fixed income is all in, I don't know, a 5-year T-bill, kind of thing, and I'm going to take my distributions off that because that's the total return. No, the building blocks of that portfolio is what you need to pay attention to. And then, your distributions are as needed, if you chose to go that route. Wade, anything there I may have missed, or Bob? Did that sound about right?
Yeah, though I would also mention, with some of those numbers we looked at in the past, that 10% stock portfolio, 90% 5-year treasury bond portfolio or treasury note portfolio, technically, statistically, that will still outperform inflation. Not by that much, and with a lot of variance, But, over the long term, you would actually probably outperform inflation. The question is, can that portfolio still be able to provide the growth needed, the real growth needed, the inflation adjusted growth needed to keep up with all of your planned spending? So it's always going to be this push and pull. It's always going to be, you just need to run the numbers. You just need to run the plan and, see what the probabilities of success are, see what failure looks like, see how everything kind of fits together, and make sure that you're comfortable with, what all of the numbers are telling you, that you are comfortable with that level of risk built into your plan, because you're never going to find a total return plan that's 100% safe. That doesn't exist, but you need to be comfortable where you are on that spectrum.
Yeah, and we did a whole arc on total return. And wait, I'm going to ask you a question here. So we don't need to get into the different types of styles. But at the big picture, I would like to just discuss the allocation piece. And Wade, you've looked at it. And, the biggest mistake someone could make here, aside from, worrying about just make sure you're taking the appropriate amount of risk, et cetera, is the allocation when they over-engineer it. From the studies that I've seen, how much of a difference is there between a 30% equity portfolio versus 70% fixed income, relative to like a 70-30? There's a range in which I say this being a little cute, granted, but there's a range where it doesn't really matter all that much,
Right.
but you don't want to go below it because then it does matter. Do you want to just touch base about that?
Yeah, in the historical simulations with US data, kind of the work Bill Bengen had done, what we see is the 4% safe withdrawal rate idea worked with anything between 35 and 80% stocks. If you got less than 35% stocks, you just didn't have enough growth potential. Even with an all bond portfolio, historically, 2.4% was the safe spending number. And then once you start getting over 80% stocks, the volatility of the stock market did lead you to dip below 4%, not by much, but on occasion historically. And then I've looked at the international data as well. And at least in 18 of the 20 countries, having at least a 50% stock allocation tended to support the highest spending in the worst case scenario. There were only 2 countries that you had your best outcome going under 50% stocks. So in historical data, generally this sort of total returns approach is pointing to not being too conservative with your portfolio. Definitely not 10% stocks is not really what we're talking about at all. It's Bill Bengen in his first article said retirees should hold 50 to 75% stocks and as close as 75% as possible. And that's something that really the precise numbers can vary from situation to situation, but the concept is there. Total returns requires being comfortable with a somewhat aggressive portfolio in retirement.
Right. And I hope that message is 100% right by the numbers. But it's easy to go too far on that statement as well. It doesn't necessarily mean have a really aggressive portfolio. 50% is fine. If we look at the financial markets as a whole, it's real easy to forget the market portfolio is 2/3 stock, or excuse me, 2/3 bonds, 1/3 stock. So the total return portfolio, kind of the total return quadrant, is almost by its nature going to be tilting more aggressive, even with what people generally consider to be a conservative portfolio. And you don't want to push it too hard because, again, as Wade mentioned, you're going to be taking, at least some of your essential spending from risky assets. It's going to be a lot more painful for you in that total return quadrant to have a down market when you're trying to spend out of your portfolio than a lot of the other quadrants. So, it's always going to be that push and pull, thinking through these trade-offs.
And so then, Bob, is it fair to make this statement? When it comes to keeping up with inflation, from a total return approach, get a healthy mix of
Yep.
stocks and bonds, and you should be fine, right?
Absolutely.
Don't lose sleep over, do I need gold for 3%, or these sort of false sense of precision in allocations. At the end of the day, get a healthy exposure to growth assets, risky growth assets, and a healthy exposure to fixed income assets relative to your overall risk tolerance, but don't try to be over precise. And the biggest issue, and notice how we're getting back to, at the end of the day, it's about allocation, right? The biggest issue is, to me, the people that fail are the people like, I'm going to put Bengen in the mix here, where, eat your own cooking, right? Where he went to cash, or he went to extremely conservative. Now he could have a ton of money, so what does he care, right? But no, it's like, who cares, right? I can self-fund everything in cash, then, bless you, congrats, whatever. But effectively, the danger comes where people when you get this sort of level of preciseness, or you get to forecasting, you go to cash for a while.
Right.
Then I'm going to go back to my portfolio. Then I'm going to go to cash. Then I'm going to go back to my portfolio, because what inevitably happens is you miss it. Mm-hmm. And then all of a sudden, then opportunity costs, inflation, and everything really hits you over the head. The worst thing you could do too is get it right the first 2 times, because then you're a self-ascribed genius, and
that's right.
At this point, you'll turn off this podcast right now.
Yeah, I think we've had an episode on market timing, or we've certainly discussed it pretty extensively. Mm-hmm. But one of the things I always talk about is, there's a reason 60-40 is the bog standard, stereotypical, retirement portfolio. It strikes a pretty decent mix in terms of, having enough in that growth portion of the portfolio, but also tempering it enough with bonds, obviously depending on what those bonds are, and obviously depending on your reaction to all of the volatility that is still inherent there. But that's where a lot of people end up falling out. That seems to be a sweet spot for a lot of people. So that's at least where a lot of people can start from and move from there.
Now, you say Boggs portfolio. You've said that all the time, and I always just...
The Bog standard?
I don't have the energy.
I have no idea
I don't
where
have
that
the
comes
energy to ever ask you that. I just assume a nod, and let's just move on.
I'm from New England, so I assume it means Wade Boggs. So
yeah, Wade Boggs, Boston Red Sox.
No, it's not.
But. No, why would that have to do with 60-40? Did you eat chicken, Wade, before you started this podcast?
Right.
No, it was the beer. So
yeah, exactly. No, but it's you don't know where that name comes from. It's somebody's name, I assume.
The Bog standard just means kind of normal.
Can you imagine? It must have been some guy at working for Samsonite, their pension fund.
Maybe it's a bog like BOG down in the bayou.
I guess I don't know. I've never put enough thought into it.
Oh my God, we've got
next time I'm on, next time I'm on, I will have an answer for you guys.
Wade's throwing out John Fogerty song titles all of a sudden. All right.
But, there is one more nuance too. Before we move on from total returns, it's not just asset allocation. Yes. Not just asset allocation, but in the intellectual history of retirement income, there was this safety first concept that if you want to have a volatile investment portfolio, you should prepare for volatility with your spending. Mm-hmm. If you want constant spending, you shouldn't have volatility in your portfolio. And we see that idea with the retirement income style awareness, where total returns, if you're total returns, it generally means you're more comfortable with flexibility for your spending. You have more of an accumulation mindset. You don't focus on predictable income. And so another lever built into the total returns concept is if I have an aggressive investment portfolio, I better also generally be comfortable, and I probably am more comfortable making spending cuts or not having if inflation ends up being higher than expected, I may not be able to keep up with inflation. And that's more built in, that you're going to be more comfortable with that idea as part of being total returns. And so then that's another lever too, because part of the whole issue of sequence of returns risk is being forced to sell at a loss. Well, if you just don't increase your spending with inflation, you're not forced to sell as much of your assets. And that becomes another way to help manage this sort of inflation risk as well.
Yeah,
I see that. I
absolutely. I mean, that's a
No,
as
I'm
much as
still soaking in that
allocation is,
intellectual history. Sorry.
yeah, as much as the allocation is a big story, that frankly is probably the bigger story. The being able to make those changes and accepting that you may need to make those changes in the future. That's almost the whole story. So,
And it's a viable strategy. It's just
yep,
recognize the game you're playing.
exactly. But with that, let's move on to time segmentation. That's quadrant 2 here.
Well, you're breaking Wade's cardinal rule, Bob.
What's that?
Wade, do you know what that is?
Well, we've got to define the term, but you didn't give him a chance yet.
You always go from total return to income protection. Bob is going counterclockwise on the matrix. That is unheard of. That is unheard of in this podcast.
Going back to like middle school math.
Oh my
I know
goodness.
the quadrants are numbered. The top, what is that? Top left with total return, that's quadrant 1. Top right,
yeah, you're absolutely right.
2.
You're absolutely correct. All right, fine. But I went clockwise when we started doing the stats. I identified it by clockwise, not traditional quadrant, and it threw us off for the rest of the data analysis. Where we were like, "Okay, what the hell's quadrant 2 again?" We were like that. It was like, wait, it's the opposite.
Yeah, that sounds about right here. So
I don't know if you remember that, Wade. Remember, we were like, it was like the coding. It threw off our stats coding because we were like, wait, what quadrant is this?
Yeah, it took me a while to get the hang of your conventions. I was having a cross-reference because the quadrants were identified with numbers, and I was having a cross-reference what those numbers meant.
Mm-hmm.
Yeah.
Okay, so
should we talk income protection now, or
yes,
mix up and talk?
No, we can. Probably easier to go with time segmentation. It's a cousin of total returns,
and it maintains the intellectual history.
That's right. Intellectual integrity here.
Wade's phrase of the day.
So, actually, Wade, why don't you do the definitions here?
Okay, so time segmentation it's shifting away from total returns because you start thinking about your portfolio earmarking different sections for different purposes based on time. And so it's bucketing. I'll have these different buckets, and I'll have a short-term bucket where I'll put my bonds to cover short-term expenses. I may have a medium-term bucket, which is more mixed. And then I have a long-term bucket, which is where I tend to put my stocks. That's the growth portfolio earmarked to cover long-term expenses. So I may still end up with, say, a 60-40 portfolio, but it's just framed differently in my mind. My 40% bonds is all earmarked more for upcoming expenses. My 60% stocks is earmarked more for longer-term expenses. And then I do have to maintain some sort of rule around when I'm going to draw from the long-term buckets to replenish my short-term buckets as I spend them. But then that gives me some flexibility to make decisions around when I do that sort of replenishing. If my portfolio looks like it's in trouble, I might let those growth portfolios ride and not refill my short-term buckets, hoping for some recovery before I completely deplete my short-term buckets. So that's what time segmentation is.
Yeah. And, it definitely has best of both worlds is the wrong terminology, but it pulls from both sides of the fence in terms of that total return and having that big chunk of risky portions of the portfolio that do have, again, that higher level of expected return, or at least that positive real expected return, positive inflation adjusted expected return. But then it does have, generally it's going to be a bond ladder of some sort there. And, that can very easily be a TIPS bond ladder that, you can get your inflation protection on that income piece pretty straightforwardly.
Yeah, and just a broader point as we start getting into the TIPS ladder again is you kind of have two options about your inflation protection. Are you going to go the TIPS route, or are you going to go the stocks route? And the TIPS route provides you a contractual protection for inflation protection. The stocks route provides you with an expectation that that stocks should grow in excess of inflation and that you'll probably be okay with that. So we're now with a TIPS ladder using individual bonds that offer a real return plus inflation, so that no matter how high the consumer price index measures, your asset will provide that additional return to keep pace with inflation.
So 2 points of clarity for someone listening in is we're talking now about individual bonds.
Yes.
Or a MIGA or something like that. But, it could be some contract. But for the purposes of here, let's just keep it simple. We're talking about individual bonds. And so you are taking them to maturity. In total return, we're kind of speaking in the world of bond funds. Yep. And you have one big thing and you're pulling it out, right? So here, because you can be say, so I want to distribute somebody think, oh, but rates will go up. And so my bonds will go down. You're taking them to maturity. So they'll be at par, assuming this is high credit quality, that kind of thing. Not like, we're not talking about junk bonds or anything like that. And so they're going to pay out in maturity. And you could add that inflation wrinkle, if you will, if you wanted to go the routes of tips or whatever. But Bob said something, I want to make sure it's caught up. Where do you want to put your inflation lever, if you will? Do you want to have it be in the bonds? Do you want to be in the investment portfolio, or do you want it in both? Right? It just depends. And Wade was pointing, and Bob and Wade were kind of pointing out that, okay, you can earmark your short-term cash needs, short-term being, let's say, 3 years or less, right? From something, right? And unless inflation just goes like crazy, if you will, you may be screwed, right? But the reality is, look what we just went through. And we spoke about it in previous episodes. Inflation's actually hovering at, was it 2.9, Bob?
I forget the exact number, and I don't know what it'll be when this one comes out. But
but think about everything.
Broadly, historically average inflation.
Yeah, it's not crazy. Like maybe 8 months ago, you were like, "Oh my goodness," right? Mm-hmm. And so, a bond ladder thing, you still need assets to refill the buckets.
Yes.
Every, let's say, 4 to 5 years, just to put out something. And so there, you kind of need that risky exposure to be able to fill those buckets in a manner that keeps up with the spending. Just putting it out there. So personally, if I'm going to worry about inflation, I'm going to contemplate that with the risky part of the time segmentation portion, not necessarily the bond part. But that's just my own personal preference there.
You can approach it in a lot of different ways. And, if you do decide to use, non-inflation adjusted bonds, that's perfectly reasonable. And depending on the length of, as your point being,
tax considerations, whatever,
of the ladder, if it's 3 years, it's probably not the end of the world. If you're getting up into 7 years, well, now it might be a little more of a consideration. But even at that point, there's nothing stopping you from, buying another bond for, that 3-year run, and kind of topping up some of the shorter term stuff if we are seeing higher levels of inflation like we have the past couple of years. But again, as Alex mentioned, right now, forward-looking inflation, as we've seen by comparing the TIPS yield versus the nominal treasury yield, it's pretty darn low. Certainly a lot lower than what we've seen, again, in the past couple of years.
And Bob, they're giving away iPhones.
That's right.
No. Wade, you were going to say something? I think it was about how the acumen of my point.
Right. But you can't fully, I did sort of say you might use the tips more with the time segmentation, but to the extent that you're using this in shorter term buckets, you're not getting that full inflation protection experience. The true inflation hedge for a 30-year retirement would be to build a 30-year tips ladder. But of course, that can also become very expensive to do. And so then it becomes ultimately a combination of some tips, but also the reliance on still the idea that stocks will grow in excess of inflation to make sure that plan is going to work in the long term.
Right. Yeah,
it's funny.
The backbone of that inflation protection, whether you're using tips, whether you're using nominal bonds, is still that higher level of expected return in your risky portfolio. And one thing to keep in mind here, especially when we're talking about tips, is that risky piece of the portfolio can get really risky. You're putting depending on your mental framing, I take a slightly different mental framing than Wade does there, but you're putting a massive chunk of your bonds in that bond ladder, a massive chunk of your your less volatile assets in that ladder, which means for a lot of people, that risky portion may not be 100% stock, but it may not be that far off either. And it's really going to come down to, what your mental framing looks like, how you want to put that together. And that can cover up a lot, or cover up's the wrong term, but that can deal with a lot of inflation there.
And just another note with time segmentation, part of the story of why it may quote unquote work, so to speak, is it gives you a dynamic asset allocation.
Yep.
And if your portfolio is in trouble,
a risky portfolio
and
here.
You're spending those short-term buckets and you're not replenishing them, you may be creeping up towards 100% stock allocation, especially if your growth portfolio is 100% stocks. So you have to be comfortable with the framing because of what it can imply with a fluctuating stock allocation as you go through retirement, and a higher stock allocation when markets may not be looking as good overall, and when most people would tend to panic and move away from not that they should, but the panic is you shift away from stocks when markets are down because you get scared. This strategy has you stay in the course, letting those stocks ride.
And the other piece, and this is going to the flip side of that logic, I think, and Bob, I'm doing this off the top of my head, but somebody has $10 million. Now it's a different beast, okay? Granted. But somebody could be thinking, you know what, the heck with this. I can underwrite everything that I need. I'm not going to spend this much, but I don't want to lose purchasing power. So I'm just gonna fill my portfolio up with 6-month CDs, and that's it. And it'll always recalibrate for inflation. I want to say Fama said something like the best inflation hedge is like a 6-month bill or something like that.
No, in fact, I think I've told this story a couple times now where Gene Fama obviously is at Dimensional Fund Advisors. And when they came out with their 1-year fixed income portfolio, which, they use their variable maturity. So it's very rarely actually at 1 year. It's usually, a couple months long in terms of duration. He wanted to call it the inflation hedge fund. They obviously didn't let him do that. And they don't let him make any marketing decisions, but that's really getting at that same idea. Having that constantly rolling portfolio does deal very effectively with inflation. And it's that rolling piece of it by bringing in the new inflation information.
That's extreme optionality, by the way.
Extreme optionality. The problem is you're also bringing in the new interest rate information. So you're taking on a massive chunk of interest rate risk along with dealing with that inflation. So again, just like everything, there are trade-offs implied here.
And that also sounds like a rolling bond ladder that you're not actually spending it, you're just reinvesting it. Whereas in retirement, you spend your bond ladder. So
that's why I said the only one that could do that is somebody that has an insane amount of money that it's like, who cares?
Okay.
Yeah. So, anything more to say on time segmentation here? I think that's, it's really going to come down to, you may want to use tips in your ladder. Your risky bucket is going to do a lot of the heavy lifting. Hopefully everything works out.
The bonds hedge, the risky assets will outgrow.
Yep.
Yeah, in an ideal world.
So, dealer's choice on
income protection
to the bottom too.
Oh, we got to do income protection before risk grab.
Okay.
Never risk grab before income protection.
Well,
risk grab is an offshoot.
Here.
Wow, he has that on stone tablets.
Yeah. Risk grab's an offshoot of income protection. So income protection is, you want to have protected lifetime income sources to cover your basic spending in retirement. And once you have that in place, then you feel more comfortable investing the remainder at this point, it can be more aggressive. You have more risk capacity. Your lifestyle's less vulnerable to a market downturn. So an aggressive, diversified portfolio, earmarked more for discretionary goals. And your essentials are covered through protected lifetime income sources. And so once you get past Social Security, any pensions, any other reliable income sources that you have, if there's still a gap, rather than drawing from the diversified portfolio to fill that gap as total returns would do, you may look to purchase an annuity, protected lifetime income, to fill that gap. And so, Bob, kind of handing it back over to you, the issue here is commercial annuities don't offer inflation protection.
That's right.
So what does the income protection person do?
Yeah, so I'd probably say this is the toughest quadrant to deal with inflation on. So, there are to the best of my knowledge, and I'm, 99.9% sure this is still a true statement. There are no income annuities that have inflation adjustments.
Bob, we spoke about that 2 podcasts ago. The only guy that last person. All right, let me ask him, Wade. Who's the last person that bought an inflation adjusted annuity? What did he do for a living? Let me make it even easier. This guy's not paying attention, Wade. This guy is just not paying attention.
I mentioned this on the previous episode.
Yeah, you mentioned this. You told a whole story about this one, Wade.
Bob was checking his emails.
Yeah. Well, that actuary is probably going to be the last one for a while.
But Bob's neurotransmitters went crazy. He got it. Yeah, he was an actuary. The last guy that
right. But maybe someone got religion in the past 2 weeks or so and is putting one out there.
They heard this podcast and said, "There's an opportunity."
That's right. I would love it if they did.
And also to note, sometimes this point gets mistaken because people will say there are inflation protected annuities, but they're talking about cost of living adjustments. Like you can get,
which I said, and you knocked me out.
Well, there we go. A fixed 2% increase every year, a fixed 3% increase every year. But though that provides you income growth, it's not inflation protection in the sense that if inflation ends up being higher, you're still getting the past
2 years when we were looking at 8 or 9% inflation, you were still losing purchasing power.
Yeah, with your.
Is it me to think I'm crazy though? I still think in the grand scheme of things, isn't a COLA at 3% good enough?
It'll get you over the course of your life, probably. But the issue is
plus Social Security, and then plus
plus Social Security, and we're talking about essential spending. We're not talking about all spending.
Yeah,
this is when. Go on. Sorry.
The issue is that sequence risk, though. If you were someone who was retiring into the pandemic, which a lot of people were, I'm sure a lot of our listeners, some of them retired because of the pandemic. Well, they got whacked with that really high inflation rate.
All right, but so they canceled their Netflix and then they buy it now again. I mean, so what?
I'm sure you have one or two irate listeners after that last statement, though.
No, but it's just you can't have it all, right? That's what it is.
So, I mean, that is definitely one avenue to be looking at in terms of the income protection quadrant. Those inflation or those cost of living adjustments do not come free, though. Those are relatively expensive riders to add on. But the whole deal of income protection, quite frankly, is pretty expensive in this income protection quadrant. So that may be a good solution.
I'm gonna call you on that, and I can't explain it as well as Wade. When Bob says expensive, what does that mean, Wade? Because I don't want people to think, it's
not expensive in that the insurance company is taking a bigger overhead on them. They're still pretty much actuarially priced, but they're pushing your spending back, so they're going to have a lower initial payout rate. So for a given premium, you're going to get less today because it's built-in increases over time. And I guess that's what I also wasn't sure what you meant by expensive, but I guess that's what you're getting at.
Yeah. I wanted to point out, it's not that the insurance companies are like, hey, here's a sucker, let's get him. It's not like that at all. It's more the environment is such that to price it out, they need to make those accommodations.
Yeah. I mean, it's the same way that buying a tips ladder is more expensive than buying, a non-inflation adjusted bond ladder. You're going to get a lower dollar value coming out for the same amount of money, I think is a fair way of phrasing this as I'm circling around the actual right answer here. But there's a couple other things that you can be thinking about in the income protection quadrant. One is, well, you probably haven't annuitized everything. Generally people are going to annuitize, their essential spending, maybe plus a little bit more depending on the situation. And if you're comfortable with the inflation piece of your spending coming from your risky assets, that's definitely a viable way. Though it is worth considering, that can end up being a big chunk of your portfolio, or a big chunk of your spending, later on in life. So that's definitely, it's a risky one.
I think that's net worth dependent. I mean, and what I meant by that is, you said, I don't think most people will be able to fund all of their essential expenses with contractual income. And that's with Social Security in mind. It's like, think about it. If someone makes, I don't know, whatever, $50,000 a year, Social Security will be a significant part of their retirement income that it will probably cover more as a percentage of essential expenses than someone that makes $500,000 a year. And so its results vary on that one. But the point is, look, try to line it up as much as you can with essential expenses. Sure, you have Social Security, that'll cover a certain part. And yes, if you do decide to go in for protection, you try to do as much as you can economically, but expect that you will need to invest in risky assets to effectively maybe try to cover everything else.
Yeah. That's Wade? A big piece here.
Yeah. And also, just in terms of how much annuity that you get, I don't think you necessarily need to overshoot what you're trying to achieve today, because of this issue that, well, over time, the purchasing power of that reliable income will decrease. You can ladder in additional annuity purchases in the future. You may find that with this whole issue that your spending doesn't grow with inflation, you're still comfortable. You don't necessarily need to make those additional purchases. You could even set aside a TIPS bond that you say frame as, well, this will be used for purchasing an additional annuity in the future. And that way you can inflation protect that, at least the premium you'll be able to afford at a future date.
That's a great point. And Bob, this is Wade, cover your ears. When I said my thing and I said Wade, like for him, I was worried that Wade, this is great. You awesome answer, out of the park, but I thought he was going to say, yeah. And that's it. and then we're like, okay, what now?
I've got more for you too on this one.
Fire away, my man.
And it's just also, to the extent that annuities can support more spending from a given asset base as you age compared to bonds, to the extent that you're using the annuity as part of your bond allocation, more of your future spending would come from the annuity, less needs to come from your portfolio.
That's right.
If you're spending less from your portfolio, this whole issue of sequence of returns risk, it's easier for your portfolio to grow. So you're giving your portfolio a better chance at growing faster than inflation because you're not putting as much distribution pressures on it. And so that's another way where the income protection approach can still, the annuity doesn't provide the inflation protection, but it can make it easier for the rest of the portfio to provide the inflation protection.
That's why I wouldn't even get caught up with the matching everything with inflation. If I'm doing this, I'll take the COLA, call it a day if I want, but I'm looking at the portfolio at that point. Because another thing Wade didn't mention that he likes to say a lot is this is now you have true liquidity, right?
Oh yeah.
But that we're running at 50 minutes. I was like,
that is to inflation.
I thought this was
it's not.
Here, so.
But Bob was like, I don't know, we have enough for today. Hold my beer. Hold our beer.
And this explains why Alex started speaking Spanish at the beginning here.
He's trying to stretch out the episode, but we still have a whole other quadrant.
We do have one more quadrant. The one we don't.
Tenemos uno más. Tenemos uno más.
Risk wrap.
I don't know how to say that in Spanish. Riesgo. Envolver el riesgo. I don't know, something like that. Go ahead.
Any alliteration available. But risk wrap, you're comfortable with the market, but you also are comfortable committing to a strategy. And ultimately, you want to put some guardrails around the market exposures that you take. You're more worried about outliving your money. So you do also think in terms of protected lifetime income. But that's where this is just like time segmentation is more behavioral. risk wrap is more behavioral. And you could simply you could use income protection. You could have an income annuity, you could have stocks. But with risk wrap, you might look at something more like a variable annuity that mixes this together, where you have the growth potential within the annuity, while at the same time you have a living benefit that provides a protected lifetime income stream. And so what does the risk wrap person do to manage inflation risk?
Pretty much the same thing as income protection and mixing a little more total return. I mean, it as you said, I mean, Wade, it's somewhere in the middle there. You're going to be more comfortable taking from that risky bucket, or you're going to be less unhappy of taking from that risky bucket that the income protection might have to do. And, the variable annuity type of framework, obviously, depending on that product, gives you a little bit more flexibility and a little bit more potential for growth there. So, hopefully getting some more of that inherent expected return, inflation protection, inflation outgrowth, if you will.
Yeah, and I think also people may need to be a little bit careful if they're risk wrap and looking at the variable annuity, because they're more probability based.
Mm-hmm.
They are more comfortable with the idea that the annuity may grow and provide step ups, and that growth could keep up with inflation. But empirically, it is difficult for a variable annuity to achieve these new high watermarks of growth during the distribution phase, because market returns have to consistently be higher than what you're spending, plus the fees, the fees providing protections, but fees plus spending. It's tough for the portfolio to keep up with that. So generally, as you go through retirement, you're going to eventually, it's going to be hard to have those step ups in growth. It's hard for the annuity itself to keep up with inflation. And so depending on your overall asset allocation, because the payouts on variable annuities tend to be less than the fixed annuities, you're also not getting to ride as much on, well, if I have this income from the annuity, so now it's easier to spend less from my other investments, so they'll have an easier time growing. But you're still going to have to spend more from those other investments as well. And so behaviorally, what you're looking for here may not ultimately be the best way to keep up with inflation. And that is a consideration with risk wrap. I don't know. It's not like every strategy is equally effective at keeping up with inflation. And that's where the behavioral nature of the risk wrap strategy could put it in a more challenging position if your primary concern is this sort of inflation protection in retirement.
So if I'm hearing you correctly, once you take distributions, you're kind of locked in on where the values are. Even though you do have that market exposure, you'll still have trouble overcoming the hurdle of the distribution and of just the general expense to get that new level. So
right,
it's
and it
before
becomes harder over time.
Yeah. So it's before this takes place, as you're accumulating, is when you could see that upside, if you will, but on a level reset, but not the other way. Not once you're taking money out. I mean, yeah, stranger things have happened, but it's not something to bank on. Is that a correct, normal
right,
parlance
you have
explanation?
To get consistent growth. Like if maybe the first few years markets are doing great and you're getting step ups, but as soon as there's one down year, even if the market then recovers, just like the sequence risk, it's hard for the contract value of the annuity to now achieve a new high water mark, because you're spending from it, and you did have that year where you're spending a bigger percentage of it.
And it's also the normal issue of, when you go down, you have to go up a lot more. If you lose 50% of your value, well, you don't just have to make up 50% of value to get back to the original starting place. Now you got to make 100% of your value. So we're also dealing with that just straight up math type of issue.
Yeah, that's part of the sequence risk. And that's known as just where it's the same with total returns, but because of the additional fees that are providing protections with the annuity, it's that much harder for the annuity to overcome the math that you just described. So, and it's a concern.
Okay. I think that's known as the Kobayashi Maru paradox. Where's that from, Wade? Come on, man. You would know.
Well, I know you've been watching a lot of anime, so I don't know.
No, Wade, seriously, man.
It's not an anime one.
So is that
do you know where it is?
Is that be aliens somewhere in the universe or something?
All right, explain it to Wade. Come on, Wade. I'm sure some of our readers have to know this. I mean, our listeners.
This is like the most basic Star Trek thing. Wait,
I'm not a Star Trek person.
Neither am I. I honestly, I'm not either.
Yeah.
So we got him. We got him, Bob. We did it. We did it. We did it. Bob, we did it. Take a bow. We did it. We did it.
Hey,
we got him.
I've seen The Godfather at least. Now you've got me.
We did it. In under 100 episodes, we finally got him.
It was close, but it is less than 100 episodes.
All right.
It's a training exercise in the Star Trek franchise designed to test the character of Starfleet Academy cadets in a no-win scenario. All right. Yeah, I had no idea what that was.
He cheated. Captain Kirk cheated, and that's how he passed. All right.
Well, on that
so where were we?
I think we've reached the end of the productive portion of the conversation.
We wrapped up the conversation, no pun intended, with risk wrap.
Oh, God.
Wait.
That's why
a star is born. A star is born. All right, everyone. Someone's knocking at the door, so the dogs are going crazy. So I got only so much time left. I'll say my goodbyes and mute this out. Thank you, everyone.
Right. Catch you next time on Retire with Style. Thanks, Bob.
Thank you.